Hello friends, welcome back. So we were discussing the payoff charts of call options, put options. So when you see this particular graph out here, you will find that the you ignore this blue curve, right? Just think of this red curve. On the x-axis you have the stock price, right? So stock price is going from 90 to 95 to 100 to 105 to 110 50, and the payoff is like negative below a certain price, and then it keeps on going. We are talking about the call option, right? So the call option buyer will have a payoff line, uh, payoff line like this. Right? This is a payoff line of a call option buyer. You can see that there is a possibility of infinite gain and the loss is limited, right? That is a brilliant feature. And just the opposite. So if the payoff line is like this, you will have a payoff line of the call option writer line, right? So when the stock price goes up, call option writer starts making losses, because essentially the call option writer is bearish, right? He's buying a call option because he's bearish, and here the market has become bullish and he's going to make loss. And this fellow will make loss when the market becomes bearish, because he is essentially a bullish fellow, right? So these are the two graphs. Remember this particular thing, that this is the call option buyer, and this is the call option writer, or the call option seller, right? So this is what the graphs look like in case of call option. Let us come to the put option. So in case of put option, as we have seen earlier, that the put option buyer is actually a bearish fellow. He expects that the prices are going to go down so that he can sell still at a higher price, higher strike price at which he has contracted for. So again, here look at this red line only, and this is a stock price going up and his profits coming down, because this fellow was essentially bearish. He thought that markets will move in this direction and that's how his profits will increase, but the markets, if move in this direction, then he starts making loss, but the loss is limited. There's no infinite loss either in call option or in put option, and that's the beauty of the derivatives. You are insured, right? You are kind of limiting your losses, right? And when you compare the payoff a put option buyer is like this, and the payoff of a put option writer will be like this. So just kind of opposite that's happening out that was happening out in case of the call option, right? Okay, so the call option payoff was like this, the call option buyer, and this particular thing is same for the put option writer. So what the payoff, the diagram for the call option buyer is same as that of the put option writer, and the payoff diagram for the call option writer is same as a put option buyer. Okay, so now let us see what we talked about, the covered call strategy. So what is a covered call in case of writing a call? We discussed about it. So why somebody would write a call? So if you go long on stock and then you write also a call, right? So that becomes your covered call, right? That becomes your covered call. Why covered call? Because if I'm writing a stock and the stock price goes up, so my typical payoff line will be like this. If the stock price goes down, it won't go down below zero. So let us say this is a stock price at which I bought, and if it comes down, if it goes down, I make negative profit also. That's true. And in case of call writing, I have already seen above, if you can see that this is a graph of the call writing. So call writing is a graph like this, right? So call writing is a graph like this. So in case of a covered call option strategy, you have something like this as the as a tiger, right? Okay, I think I need to check this. I'll need to check this, right? Okay, now you can have a married put strategy. So what is a married put strategy? It's a long on stock and a put buy. So you say the put you have already seen that the put buy is having a curve like this here. So put buy is like this. So this is your put buy, and then you are buying a call also. So ultimately this particular line will be the net married put option strategy, right? So what you've done in a put option strategy, you are long on stock and then you are a put buyer. You're long on stock and then you are a put buyer. So with this you limit your losses, but your gains are still infinite, right? So let us talk about option spread now. So what happens in case of option spread? This is very important. So there can be a call option or put option spread, right? So it is called a strategy, call strategy, put strategy. So let us take it like this. So we are buying a particular call option of say Coal India Limited, which is being sold at 8.45 rupees at present, and at a strike price of 125. We write another call at a higher strike price for which the premium is 3.1 and the strike price is 130. Now what happens at the expiration if the stock price is 120? So in case of stock price is 120, I have a call bought at 125. That means I'm not going to exercise this, and the one to whom I have sold this 130 call is also not going to exercise this because market price is in any case lower than 130. So nobody is going to exercise the calls. Only profit and loss will be in the case of premium. I have paid premium this much, I have got premium this much, still I am losing this much, right? So long call value is zero, short call value is also zero, and whatever remains is your premium, right? In case of 125, uh, uh, again the same calculation is done, that it won't be exercised because market price is same, and somebody who has bought a call will also not exercise. It will also not exercise. So again, only the premium play remains, which is negative 132. Okay, what happens at 130? This is interesting because I'm going to exercise my call option bought at strike price of 125, but that 130 fellow is not going to exercise this. So what happens is that I gain 5 here, right? And short call value is 0, and the premium, forget about this, the premium is still minus 3.2. We'll calculate the profit just now. In case of 135, similarly, long call value is 10, the short call value is negative 5. Why so? Because now this fellow is going to exercise to whom I have sold at 130. So he's going to exercise this 130. He's going to, I'll have to shell out 5 from my own pocket. So the net from the call value is 5, and still you have net premium negative. So the profit is there, but not too much. At 140, your profit actually increases. Right? So this is how this particular strategy is going to work, and we're going to see the graph also, right? But to clearly understand, look at this table here. I have bought, what I've done in a it's called call bull spread, and I have made these two transactions. This is one and this is second, right? And you can see that if the market price is 120, I'm going to get minus 3.2. If the market price becomes 135, I'm still making losses. And at 130, I start making profit, and that profit remains constant. So there is no infinite profit in call strategy, right? No infinite profit. So the graph uh, actually looks like this for the call. It's called call. You have bought one call at a lower strike price, another call at a higher strike price, right? So the important thing here is that same expiry date, and they are same call and call. So same type of options in this case of bull spread. And the example, if you see, instead of buying the call, I have bought the now put. I have bought a put at a lower strike price, and I have written a put or sold a put at a higher strike price of 130. right here. This is the premium. This is again the Coal India real data that we have taken from the stock market, right? And here, if you see that the premium that you have to shell out is 2, the premium as a writer that you get is 3. So here the net premium is a positive, right? So when the market price is 120, you have written a put option to sell at 125, which you will exercise. So your long put value will be fine. It will be 5. But to whom you have sold the option to sell at 130 is also going to exercise, because market price 125 is lower than 130. So that is going to give you a market price 120 is lower than 130, and that's going to give you a negative 10. So the net value from this long put and short put difference is negative 5. And even if you adjust your premium, you get minus 5 plus 1.7 is still negative. At 125, which is lower than your 125 put option, again you are going to get negative. At 130, the scene changes. What happens at 130? You are not going to exercise your put option because the market price is more. You will sell it at the market price, not at the put strike price of 125. You will not exercise this, right? And your call option holder, put option holder, to whom you have sold a put option of at a strike price of 130 is also not going to exercise it, right? And the net value is 0. So what you gain is just the premium. And the profits start when the market price goes up, up, up. So 140, nobody exercises their options, but the premium remains. So the maximum you gain in this strategy is premium. So in case of put, maximum gain is limited to premium, right? In case of call, also the maximum gain was limited, but not to the premium. It was a different amount there, right? So if you are using a call strategy, buy a call option at lower strike price, sell or write a call option at a higher strike price, the payoff diagram will be like this. In case of put option, put bull strategy, where again you are buying a put option at a lower strike price and selling a put option at high strike price. This is same. Why so? Because this is the nature of the bull spread, whether it is call or put, the diagram is same in case of both, and both are like bearish strategies. Both are expecting market prices to go up. So, okay, so this was your price spread. We are expecting, the price only is going to differ. The market, the two options that we have, used in this strategy. One is to buy, another is to write. They have a different strike prices. So this is a vertical spread. This is also called the vertical spread, because the market price, if on a vertical axis, you have bought one option here, written another option here, whether it is call or it can be put, it can be call. So at lower strike price, you buy it, and at higher strike price, you sell or write it. Right? So this is your vertical bull spread. Another can be time spread and the calendar spread. And when you multiply both of, when you use both of them, right, it becomes a calendar spread. So this is your bull call spread, right? Now the the beer pull spread becomes little different. This is the payoff diagram of a beer pull spread, and thanks to Investopedia, some of the diagrams that I've used are from Investopedia. Now a beer put spread is what? Buy put at a lower price and write put at a higher price. So this is going to give you a payoff like this. And similarly, if you have a beer if you have a protective collar, and protective collar is a different hedging strategy, where you are buying it out of the money put and you are writing an out of the money call. So put and call, that becomes your protective collar. Some strategies are like long straddle, where you buy a call and you buy a put. So this is how a long straddle strategy looks like, right? So this is a payoff diagram of a long straddle strategy. So basically, you whether it is losing too much or it is gaining too much, you are gaining. So if you are expecting large difference either side of the spectrum in the stock price, then you are going to use a straddle option strategy. Another one is long strangle. Long strangle means the plateau here and then the price goes up. So when you are expecting this kind of a market, that it can be either bearish or bull, it can be either bullish or bearish, but the strike price is in between, right in the middle. That becomes your long strategy. So points to keep in mind when you are going to buy options. So what is your forecast? Are you bearish? Are you bullish? If you are bullish, then you're going to buy a call option or you're going to write a put option. If you're bearish, you are going to write a call option or you're going to buy a put option. When you are expecting that forecast, so is it days? Is it weeks? Right. So if it is if you are expecting that it is going to be going to go bullish, you know, in next few days only, then you will buy the next week call. And if you are thinking that it's going to take more than 5 weeks or something, then you are going to buy a next month call, because in the market your call options are available for an expiry of 1 week, 2 week, 3 week, or even months also. Timing, that's why, is important. Imagine uh, a Tata Chemical stock, and you are expecting that prices will go up. You are bullish. You buy a call or you sell a put. If you do that soon often, that's going to give you some profit, right? Otherwise, you have to buy the next month expiry options. Okay, what is the general outlook for the market? Is it going to be bearish? Is it going to be bullish? Which option would you consider? In the money, out of the money, at the money. So this is what you have to think when you are investing into the options strategies. So whether you want a high strike price option or a low strike price option, what exactly you want. So if you are able to clear yourself about these questions, you can make a fruitful investment into the options market. So let me give you a quick recap. What we try to discuss. We try to discuss exchange rate effect, the moneyness of the option, the motivation of the call buyer, call writer. We also discussed the payoff charts, and I believe that the basics of the payoff charts will be clear to you. And if this much is kept in mind, that for say, I'll just make some small diagrams here. So this is your call option buyers chart, and this is your put option buyers chart, and then uh, okay, let me show it to you here. Okay, uh, let me correct myself. These were not the these were the hedging strategy, the call and the put option charts. But I was talking to you. Let me come back to here again. So this is your bullish spread chart. This is your bearish spread chart, and the call option chart is basically like this. It won't flatten out like it has flattened here, and the put option chart is going to be like this. So if you just remember, the call option is like this and the put option is like this, right? So you just keep this in mind. Okay, thank you so much.